We did previously say it is a big week in the market, a lot of huge companies reporting, and today, whilst we are focusing on Caterpillar that did report their earnings just this morning, when we take a look at the overall market, we are seeing a lot of red. We see Microsoft down over 4%, Google down over 4%, Meta down nearly 16%, red across the board. And when we take a look, we still have some big earnings today after close, notably Microsoft and Alphabet. So it will be interesting to see where this goes. Now, today's episode, we are specifically focusing on Caterpillar, which is down nearly 8% after reporting their earnings. We're going to analyze why this is down so heavily for such a high quality company when we have one strong buy, one buy rating, and one hold. As always, we will do our deep dive. We will look at this company over the longer term, their revenue growth, their bottom line net income growth, as well as looking at the health of the company, total cash versus total debt. As always, we do look to both insiders as well as institutions to see if they have been buying or selling. And on top of that, looking at their dividend safety, their free cash flow, a lot of metrics. And in today's episode, we also want to see what happened in their earnings. Why has the market taken this company down nearly 8%? And as always, we will run them through our valuation model. What is our intrinsic value? What is the acceptable buy price? And what are Wall Street forecasting for upside over the next 12 months? Now, before we do just jump into their earnings, just as a reminder, they do currently trade in the mid to upper end of the 52-week range. They now have a forward P of 17.2. Bear in mind the S&P on average is around 21.5, and we can see a forward P of 1.43%. Now, even with the drop today, they are still up around 63% over the last 12 months. And over the last 10 years, if you are a shareholder, you would be up over 221%. If you were to reinvest those dividends over the last 10 years, you would be up slightly higher. And we do know their all-time highs aren't too long ago, around the 382 mark that we have seen a few months ago. Now, when we take a look at their earnings to understand what happened, well, they reported earnings per share of $5.60. Now, this was positive for the fact that we can see $5.14 was expected by the market. On top of that, $4.91 was what they reported for the same quarter in 2023. So a beat not just on analyst expectations, but also from the previous year. When we look at the revenue, now what we do note is in fact they reported $15.8 billion. Wall Street was anticipating $200 million more at $16 billion. And we also note they did in fact come in slightly lower than the number they had in the same quarter last year. In terms of a positive news, well, they did have slightly higher operating margins, 22.1% versus 21.1% in 2023, and we do like to see operational efficiencies. Now, when we take a look at their quarterly review, there are some interesting points to note. So what we can see when we talk about their first quarter versus the first quarter in 2023, their revenue was flat. Now, this isn't something that I do like. As a minimum, I do want to see it increase in line with inflation at 3 to 4%. However, we know they did improve on their operating profit as well as their profit per share, as well as their essential earnings per share, which is very important for a company. We do always want to see increasing earnings. Now, when we take a look at this on a graphical scale, what we can see, the revenue, whilst they did like to say in the beginning slide that it was essentially flat, it is slightly down around 100 million. However, we do know a beat on a profit or operating profit versus the previous quarter, and the same can be said for their adjusted profit per share. So in overall, what we are seeing is the market is punishing them. They are essentially down in terms of their revenue, not just from analyst targets, but also from what they reported from the same quarter a year ago. Now, we will look at the forward guidance shortly, but let's take a deep dive at this company. We'll first start off with the health of this company, their total cash versus total debt. Now, what we note, 6.3 billion reported in terms of the cash on the balance sheet. In their latest annual report, 8 billion. So they do hold more cash than they did 10 years ago, but we can see pretty inconsistent over the longer term. Not necessarily a red flag indicator, just something to bear in mind. When we compare that 8 billion on their balance sheet versus their total debt numerically and directionally, what we note, it has pretty much remained fairly flat from 39.3 billion to 38.45. So overall, whilst their cash has marginally increased, Their total debt has barely moved. We do see some movements year to year, but overall it does remain fairly flat. Not necessarily a bad thing either, but what we do need to understand is their net debt to EBITDA level, which will correspond to their dividend safety. In terms of the revenues, well, as always, we do want to see growth minimum 3 to 7% year on year. But one thing we want to point out with the industry that Caterpillar operate in is you can argue there is a fair amount of cyclicality in the industry, so it may not be as straightforward. And what we do note is an increase from 55 billion in 2014 to 67 in that latest report. When we do look at it, when we see in terms of the graph, very inconsistent. Again, do note the cyclicality, hence why it isn't a graph going straight up. And this is something you should factor in when we look at not just our margin of safety, but your own essential investment thesis. How does the bottom line look? Well, whilst the top line has improved, but although marginally, we see their net income has gone from 2.5 billion in 2014 to 10.3. So very nice to note they're increasing their bottom line, even though their top line isn't increasing at a very rapid rate. And we do also want to point out, similar to their top line, their bottom line is very inconsistent. Again, cyclicality in the industry. Now, what we also like to do, look at a few metrics, and we can already see that it is coming down further now, 8.5%. What we get for their growth rating is a C+. Now, not the greatest rating that you want to see. A few reasons for this. First one, on a forward-looking basis, their top line is expected to grow 5.5% when the sector median is coming in at 6.14%. The other thing that we do want to point out is the earnings per share in the long term, 3 to 5 years. They are expecting around 8.8% year-on-year increase, whereas other companies in this industry are expecting double digits at 12.11. Now, these are just ones that we pointed out that are fairly poor, but they do have some very strong metrics in other areas. Their EBITDA growth, both year-on-year as well as forward-looking, do beat both the sector medians, which come in around 8%. So there is some nice metrics, but there are also some things just to take into consideration, like their earnings per share on a forward basis is looking to be lacking in terms of comparison to the industry. Now, when we look at their profitability, a different story. We can see an A+ rating, the best rating possible. Few things to note. While their gross profit margin, 32%, slightly higher than the sector at 31%. Their bottom line coming in at 15.41, significantly better than the sector at just under 6%. And there are other margins that we can see that do look very positive for Caterpillar. So whilst we note their growth had a rating of C+, which is very poor, we do note their profitability is looking very strong. Now, what we always like to do is the overall performance, total return, that's including those dividends reinvested, versus others in the industry. We have PACCAR Inc., we have Cummins as well, lots of very strong companies that we have in fact reviewed on an individual basis, so do check them out if you are interested. Over the last year, this includes those dividends reinvested. Even though Caterpillar is up 51.66%, we in fact note that it isn't the best of its competitors during that period. But nonetheless, an incredibly strong return. When we take a look now on the 5-year, what we do note for Caterpillar is 175% growth. When we compare it to others, it is pretty much up there, second in fact to PACCAR, ticker symbol PCAR. Over the longer term, so over a 10-year stretch, we do note the second best. But when you look at them individually, a very strong performance if you have a company in your portfolio that over 10 years returns 316%. As always, factor in that past performance is never an indicator of future. So in terms of what they will produce going forwards, that is something you will need to analyze on your own. When we take a look at insiders, well, 0.33% insider ownership, we see 29.81 million worth of sales by these insiders over the last 12 months, significantly more than the one insider buy that we have noted over the period. The last more recent insider selling was Q1 of 2024 of 15 million. When we take a look at these insider sellings, what we can note, we have insiders, in fact, in February that have sold quite a significant number. In fact, the CFO himself did sell around 10,000 shares for around $3 million. We are now going back to around February at the beginning, so do factor that in. But as always, do take a note if you are interested. We do also see a buy in a fairly recent period, 23rd of February, which is a bullish signal, but as always, the amount could be seen to be fairly trivial, so always come to your own conclusions and do your own due diligence, and never copy what institutions or insiders do. Speaking of institutions, 71% institutional ownership, we see pretty much around the same number of sells as buys over the last 12 months, and in fact, in the more recent quarter, Q1, we see exactly the same number of buys as sells. Q4 and Q3, we do see a little bit more buying than selling. So interesting to note that with this company, insiders and institutions, we do know two different ways, with insiders selling a lot more and institutions undecided with the equal or roughly equal amount of buys as sales. Now, before we do jump into that dividend safety, we just wanted to point out a few things from their forward guidance. And when we do take a look, this is for the full year of 2024. They do expect the results in terms of the sales to essentially be very similar to the forward level of 2023. So no real growth from 23 to 24, something just to keep in mind, as what we do like to see, as we always mention with companies, is to be increasing year on year. You want the top line to increase. You also want margins where possible to increase to get a very, very strong performance out of companies you invest in. In terms of the second quarter, so when they will report over the next few months, they in fact expect to see Q2 sales to be lower than the same quarter from 2023. So lots of things to consider with the growth. You can probably understand now why the shares are dropping, not just in essence of the news that they missed on the revenue, but we also see that the performance over the full year as well as the next quarter isn't going to be anything that is growth from previous quarters and previous full years. Also, just to let you know, we have released our latest free weekly article. Now, we do discuss on how to find undervalued stocks. We run through all of our resources, what websites we use, as well as many other articles, all completely free. If you want to gain access completely free and instant, do click on that pinned comment below. Now, dividend safety, it is very important, and we do get a score here of 93. It does look to be safe. Market cap 182 billion. It is a mega cap company. So when we take a look at the recessionary metrics, well, last recession, they in fact increased the dividend during the 07-09 crash. They did have below average growth and significantly below, -37 with the S&P coming in at -12, and they also massively trailed the S&P, -70 with the S&P bringing in -55% return. Dividend growth, well, what we like, double digits, but what we do see, 8.3% last summer, so towards the higher end of the single digits. Over the last 5 years, 9%, fairly decent. And over the last 20, year on year, double-digit growth. So that is fairly positive, something that I would say is a nice dividend growth company. And they are a dividend aristocrat. They have been increasing those dividends for the last 25 years or more. As always, for those that are newer, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a signal of overvaluation on the yield and a signal of reasonable valuation on the forward PE, 15.8, not too far off the 5-year, rolling at 15.6. And we can see it is slightly lower than industrials, 19.2 sector PE. Now, with these different models, as always, we don't look at any of them in isolation, and we will conclude towards the end. Free cash flow payout, that is the one we draw your attention to. Earnings is susceptible to manipulation by management through accounting, and below 40% is the preference for this industry. Now, what we can see is over the longer term, it has been above that, as we can clearly see. My own preference, below 60, my blanket rule, that does give me faith that management are able to essentially offer those double-digit increases. Nice to note, 2023 and 2024, it is expected to be lower than 30%. So hopefully this summer, we do see a nice double-digit dividend increase. Free cash flow, as always, invest in companies that grow their free cash flows. With Caterpillar, again, bear in mind the cyclicality. There isn't massive growth consistently over the longer term. However, if you were to look from 2014 to 2023, you would see the increase. Also note they are expecting very minimal growth to that free cash flow. In fact, fairly stable into 2024's full accounts. Sales growth, this is very typical of a company that is cyclical. We see years of negative growth, in fact, double-digit growth, followed by years of positive growth. Last 3 years have been very strong for this company. Bear in mind, 2024, we are expecting it to be flat as we ran through on the financial outlook. And what I always say with cyclical companies, you want to be buying them when they are out of favor, when no one wants them, and then be riding them into the popular cycles. Now, Sales growth, we saw this already in a different format. Shares outstanding, it is nice to note that they have returned excess cash through those share buybacks, but we also note periods where they have done from 2016 to 2017 share issuances. On a more positive though, overall we can see the share buyback net effect. When we take a look at ROIC, as always, 10% or more, so we do get that faith from management and they are able to effectively allocate their capital. Last 3 years, very strong in the double digits, but again, do note they have had some years, and these were the very worst years for them when we're looking at their sales growth, where in fact it was low single digit. Margins, some years good, some years great, some years poor, as we can see, but overall operational efficiency, 2014 at 7%, 2023 at 20%. In terms of the free cash flow margin, every single year above the minimum. 2023 did look like a positive year for them as well, improving significantly from the 9% in the previous year. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, corresponds to both dividend safety as well as balance sheet strength. And as always, these numbers that we see, they're effectively the number of years it would take the company to pay off all of their debt net of cash on hand. And we want below 2.5. Very low over the more recent period, 0.53 in 23, 0.52 next year. So this company, no worries, we can see why it has a very safe dividend score in conjunction with the low free cash flow payout. This is looking like a strong company purely on a balance sheet and dividend basis. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button, and don't forget to let us know your thoughts as we do go along today. So jumping into the first model, we do have Graham's valuation. We have the earnings per share, the long-term growth rate, the current yield on AAA corporate bonds, and we get an intrinsic value that pretty much signals reasonable valuation. It is a few dollars shy, but we do see the overvaluation here due to this being higher. As always though, we're not looking at any of these models in singularity. We then have the multiples valuation model, companies in a similar sector and size that we analysed earlier, their average P multiplied by the EPS of Caterpillar, and we get a signal here of overvaluation indicating that the forward P of Caterpillar is significantly higher to some of its competitors. We then move on to the next model, the dividend discount model. Some very nice growth, in fact double digit over the longer term. We've gone 6.5% forward looking, a lot more conservative, and we get a small undervaluation signal here as we can see the intrinsic value at 369 versus the market value of 334. We then move on to the discounted cash flow model. We've gone for the free cash flow year on year. On average, it is up around 10.5% year by year. Last year, we see a massive increase by 76%. Forward looking, we've tried to be a lot more conservative at the 5% level. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get that undervaluation signal. The intrinsic value then is just the average of these four models today, and it does arrive at the total value of $340. As always, you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. So right now what we have is a company, Caterpillar, that is trading at pretty much near its intrinsic value. So what we would usually do is we would use 10% to start off with, and we'd execute on that if it met three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Today's episode, we can see it doesn't even get to a 5% margin of safety just yet, so we would say it is trading at pretty much its intrinsic value. What do Wall Street say? Well, over the next 12 months, they believe the share price will go to around $340, upside of 2%. They are pretty much bang on our intrinsic value, so they see very, very minimal upside. And in fact, at the beginning of the episode, Wall Street did indicate this to be a hold. As always though, do let us know your thoughts in the comments below. Is this one you are looking to add? Maybe one you're looking to sell after their earnings? For me, this isn't one that I do hold directly. It isn't one realistically that I would like to add to the portfolio unless we saw some very, very deep value. We're talking around 25 to 30% margin of safety. So for me, this isn't one I am looking to add. But as always, interested to hear your thoughts and comments below. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.